Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on the 10th day of July, 2018. I want to thank each of you for listening to the show, making it one of the more popular shows on the Voice America Business Channel, and I want to invite you to keep sending along your questions, comments, criticisms, and praises to questionsfortaylor@gmail.com. Questions, the number 4, Taylor@gmail.com. We do want to thank our sponsors for making this show economically viable. Our sponsors for this week are RN Resources, Balmoral Resources, Bonterra Resources, Genesis Metals Corp., Klondike Gold Corp., Northern Empire, and Novo Resources. Regarding our sponsors, I should note that Klondike Gold released a few assays today that I think are very positive in that they demonstrate the presence of disseminated gold beyond the high-grade quartz veins. It potentially means that the mining costs could be significantly lower than if they had to mine narrow veins. So the market sold off anyway on the news. But from my point of view, as a longer-term investor rather than a quick-buck speculator, I think the news is very positive, and this company remains one of my top picks. Another favorite, Novo Resources, also put out news today that it is not the kind of news, though, that drives stock prices, but is important nonetheless. Novo reported that it has reached an agreement with the Aboriginal tribe with regard to that very extremely large land position that Novo controls. So not the kind of announcement that drives the share price, but very important nonetheless, and I do hope to have some market-driving news from Novo. Primarily, I'm looking forward to the bulk sample assays, and at that time, hopefully, Quentin Henning will be able to join me on this show as well. Well, I've titled today's show, The Russians Are Coming, The Russians Are Coming. Jeff Clark, Dale Ginn, exploration geologist at Bonterra Resources, and Michael Oliver are this week's guests. John Kerry warned Wall Street that if the Iranian treaty were torn up, the U.S. might find the dollar hegemony under attack. And lo and behold, just yesterday, news was announced the big 3 countries in Europe, England, France, and Germany, have agreed with Iran to commence trading with that nation without using the dollars as a medium of exchange. And after President Trump abandoned the Iranian agreement, Russia sold 1/2 of the U.S. Treasury holdings that they held. Perhaps it would be more accurate to say that the Russians are going rather than coming, that is, going out of the dollar, because in 1 month alone, April, that is the month of April, Russia sold 1/2 of its holdings of U.S. Treasuries, taking it from $100 billion to $50 billion. Well, we'll explore Russia, their treasuries, the dump of treasuries, and other related issues with Jeff Clark to get a read on what, if anything, that might mean for the major markets. But before we talk to Dale Ginn after the first break and Jeff Clark, I'm happy to tell you that our most frequent guest, Michael Oliver, is back with me again today to give us an update on what his structural momentum models are telling him. Thanks for joining me again, Michael.
Good to be back, Jay.
Always good to have you back, and it's always good to tell my listeners it's OliverMSA.com, OliverMSA.com to subscribe to Michael's letter and to catch up with what he's doing. Well, Michael, yesterday you put out a really interesting message. Most of them are always interesting. I always find them helpful, especially those markets that I'm most involved in and care most about. But this was a message that was titled, "The Earth Beneath Your Feet is Moving." Are you suggesting a tectonic movement for the markets? And if so, which markets are having their foundations shaken by tectonic movements?
Well, they all are, but the one that is probably the most confusing to most investors is the stock market, especially the developed stock markets, U.S., Europe, so forth, where there's a lot of sideways congestion for the last 5-6 months. Up, down, up, down, up, down, with no real, nothing but wheel spinning. But it won't break down. I think there's reason for that. But we do a lot of work within sectors, within markets, and not just look at the price or the momentum of price of a given market, but its relationship to other assets. So we run spreads. Now, spreads are common. You see them often. Most of the time what they do is they overlay a price chart of one company and another company, and you'll see them go off in different directions. That's not what we do. We divide one into the other and come up with one single line, okay? Mm-hmm. So that's the spread. It's the difference between stock A, stock B, or sector versus the broader market, which is what we looked at the other day. And we ran all the major sectors of the S&P 500 against the S&P 500, and naturally, since 2016 lows, anybody could guess that the outcome is that tech led the way up. It was the outperformer. That internet led the way up. And finances also led the way up. They peaked in terms of performance several months ago. And they've had a very hard down hit in the financial sector relative to the S&P. And what's so funny recently is that, now also on the other side of that equation are sectors that underperform during up markets, and those would be things like utilities, consumer staples, and this time around healthcare. So like the XLV ETF has gone down for the last 2.5 years relative to the S&P. In other words, on a spread basis, it's not gained as much. Okay, so we had 3 that were underperformers for the last 2.5 years, and 3, PNQI, the internet, XLK, the tech sector ETF, and VFH, the financial sector ETF. We ran spreads on those. And the 3 that have been outperforming are weakening. Now, some of them are nearing levels that could totally break the 2.5-year trend down, meaning they're not just weakening versus the S&P within the context of an uptrend. They're breaking the uptrend. So not far away. And what's so curious is that over the last several-week rally in the S&P, the spreads have been going the wrong way in all 6 of those different spreads. The 3 underperforming sectors, consumer staples, healthcare, and utilities, have been rising in relative performance to the S&P, while tech, internet, and financials have been going down relative to the S&P. That shouldn't be happening, especially not across the board like that. Which tells me that the leaders aren't leading this rally. It's the dogs of the market. So the defensive plays are leading this rally. People are buying more defensive stocks than they are the S&P. So that's a curious technical phenomenon. That's why I said the earth is moving under your feet. It's not in front of your eyes. It's happening under your feet where you're not looking. And I think that spread relationship has to be watched, and we're watching it week by week in each of those 6 different sectors, because if we get a uniform shift in enough of that group of 6, three defensive sectors, 3 outperforming sectors, then I think that's going to be a heavy tap on the shoulder that the market's ready for the next big down wobble. The first one was in February, and since then they've sort of gone numb. The next one I think will be more serious. But that spreads are warning that something's not right.
Well, some people might argue that that's just natural rotation, that's a healthy sign, in fact, that you need to have this soil turned over, so to speak.
Yeah, we'll see.
But your sense is, people believe what they want to believe, but you're suggesting that this is very unusual.
Yeah, I'm saying that this is happening at a curious time, and also the technical structure of these spreads, if you plot them, and then plot the momentum of the spreads as well, you see vulnerability. In other words, you see trend structures right below them, such that if they sneeze, the outperforming ones will break the 2.5-year uptrend of outperformance. The underperforming ones will break out above the 2.5 years of downtrend in relative performance. And those reversals like that I would need. I can say this confidently: if all those 6 turned, I don't even need to look at an S&P chart.
Interesting.
It's going to go down. Okay.
Well, I mean, this is obviously your subscribers on a regular basis will get this information as it becomes available, and this is just another example of the kind of work that Michael does, and the reason I just love to keep up with what he's doing. Michael, we have a couple of minutes left yet, but what about the gold markets now? How are they looking to you?
Stabilized. I like some of the action last week did some good to some short-term indicators. The downtrend has been underway since a really monthly momentum peaked in January of this year. So we've had 6 months of downside pressure, and usually when you measure via monthly momentum, that's about all you get. And then, therefore, what we did is we shifted down to weekly momentum to see signs of upturn, credible upside breakage to the upside. Not just rallies, but rallies that break out over something. And if you can close this week out, we got high enough intra-week to look good. if you can close the week out around 1261 or so on the August gold, I think you put your shoulder up over the curbstone. You're through. The downside's over. And we're trading, in the mid 1250s right now. Our high's been 1266.90 the other day. So we've traded at levels this week that if we could just hang in here and close up in the upper $5 of the weekly range, I think you're making a turn. And the question then is, well, let's say you're making a turn, how fast do you get back to the highs? It's probably a function of some other markets as well.
Sure. Sure. Well, I mean, I'm looking at in the cash market, 1255 now. I noticed at 1265 yesterday. So I guess next week probably that number would come down. The number you
yes, these numbers adjust down each week. So what I want to see this week was a trade up to 1266. We got that, but I wanted to see also a weekly close over a certain level that was specified in the weekend report, and then we've seen that level this week. If we can just close the week out above it, then I've got two of my weeklies saying, okay, this is the shoulders up over the curbstone, and the low in the 1230s that was it. So I just need the weekly closing evidence to make that statement.
We might be having some wind at our backs, us gold bugs, I suppose, if the dollar weakens. And I noticed in your charts on the weekend, the European financial sector and the euro currency seems to be in a stronger position, which I guess would bode not so well for the bulls of the dollar.
Right. Well, the euro is over 57% of the dollar index. So
right.
it is the one that must move in order to cause the dollar to go up or down. And the euro, of course, did move since late 2015, or from 2016, late 2016. It went from 104 to 125. Now, since then, it's backed up to 116. Right now, we're trading either side of 118. And we regard this pullback from the 125 level as a corrective pullback in an uptrend, just like we regard the dollar rally from 88 and change up to 95 and change to be a counter trend rally. Right now, the dollar is trading either side of 94, high 93s, low 94s. So it's pulled back. So,
and yet, all your work is suggesting that we're in for increases in interest rates, the long bond, and so forth, rising dramatically, right? So.
Right. I still favor the bonds rallying, yields dropping a bit over the let's call it next month or so. But ultimately, the major trend there is down in price for the T-bonds, up in yields. We're having a counter-trend rally in T-bonds right now. Actually, it's more of a period of stability than a rally. But it's curious when it happened. When did it happen? It happened when the stock market wobbled hard.
Right.
So once the stock market showed vulnerability, the bond market stabilized. Why? Because obviously some money went from stocks into bonds.
Right.
Ultimately, those who are buying bonds will regret it, but it's one of those temporary things that happens.
Yeah. Well, it's the markets exhale and inhale, as you point out, and and sometimes for a long period of time it seems to do one more of the other, but nonetheless, in the short term, it has to exhale, inhale. That's really all the time we have, Michael. Thank you so much for your insights.
Thank you, Jay.
As always, always a pleasure to hear your views on things because they are refreshingly different from the mainstream and what we hear every day. So it isn't always the case, folks, that you can get something, that you can't get something for nothing. You get a little bit of a teaser from Michael for nothing when you listen to this show. But frankly, if you really want to take advantage of his work, you need to go to olivermsa.com and sign up for his excellent newsletter. Thank you so much, Michael. Look to do it again next week if you're available.